Good morning and welcome to the Killik & Co market update. This week, the Bank of England has decided to leave interest rates on hold at their current record low of just 0.1%. And this came as quite a surprise because markets had priced in a 58% chance of a rate rise. However, only 2 members of the Bank of England's Monetary Policy Committee voted to raise rates, the reason being they are concerned about rising levels of inflation. Low interest rates are bad news for banks, and therefore we saw significant share price falls in UK banks on the day of the announcement. Shares in Lloyds Bank fell by 4.46%, shares in NatWest, formerly RBS, fell by 5.6%, and shares in HSBC fell by 2.47%. They weren't down quite as much as the other two because HSBC is primarily an overseas bank with less exposure to the UK economy. Over in the US, the Federal Reserve has also decided to leave interest rates on hold for the time being, although it has decided to start tapering back its monthly bond purchases. Here's a quote that we've taken from the Federal Reserve's statement. It said, "The committee decided to keep the target range for the federal funds rate at 0 to 0.25% and expects it will be appropriate to maintain this target range until labour market conditions have reached levels consistent with the committee's assessments of maximum employment, and inflation has risen to 2% and is on track to moderately exceed 2% for some time." So that suggests that the Federal Reserve is willing to leave interest rates at low levels for some time yet. The interesting point was this point about maximum employment, because we know that record numbers of people have been leaving the US workforce over the last year, and some sectors, particularly hospitality, have really been struggling to recruit staff. So this is an area that we are keeping a close eye on. Nevertheless, the market reacted well to the fact that US interest rates will not be going up, and the S&P 500 has reached a new record high. Global leaders have been meeting this week at the Climate Change Summit in Glasgow, and one of the biggest headlines to come out of the summit so far has been the agreement of over 40 countries to stop using coal as a fuel. However, the biggest users, that's China, India and the US, have not signed up to this agreement, and furthermore, China, which is the biggest user, is not even present at the summit. Here's a chart showing use of coal by region over the last 20 years. And as you can see by the blue line, the use of coal in China has been rising steadily over the last few years. And furthermore, the use of coal in China is more than the combination of the use of coal in all other developed economies combined. That's shown by the green line. The good news is you can see by the green line that use of coal in all developed economies has been declining in recent years. However, there's still a huge amount of investment needed into non-fossil fuels and renewable technologies. And finally, back in 2018, Apple won the race to become the first company with a market capitalization of $1 trillion. However, Microsoft has now overtaken Apple in terms of market capitalization, and Microsoft is now worth over $2.5 trillion. Here's the 5-year share price chart for Microsoft, and you can see it's recently hit a record high. Microsoft's last set of results beat expectations, and the company achieved earnings growth of 25% in comparison to last year, whereas Apple's results came in below expectations because the company had experienced some problems with its supply chain. So please do give us a call if you'd like to hear about these two companies in a bit more detail. Moving on to have a look at next week, we're expecting results out from PayPal, Walt Disney and Tencent. That's it from us. Enjoy the weekend, and we'll see you next Friday.